today I wanted to talk about valuation, specifically early stage and intellectual property. Most of my work now is actually based out of Manhattan. So most of my clients, I'd say probably 95% of them are going through a divorce right now. And I serve as an expert witness for them at trial. So I testify throughout the year as an expert witness, telling giving my opinion as to what businesses are worth, doing forensic accounting. And I am from upstate. I'm from this area, but I started my practice about, it's 8 years ago now, back in June. And we have a small team of 10 people that do valuations. And just being involved, in Manhattan, that type of, there's a lot of early stage companies, a lot of hedge funds, private equity funds that I get involved in. So I've had to really dig into these complex partnership agreements with venture capital firms and hedge funds, really understand all the quantitative aspects of the legal aspects of it. So it's really challenging and fun. But I also I'm an employee now again. So I sold my business, private equity identified my industry as consolidation. So they went out and they've been buying companies like mine. And so they acquired my company about a year ago now. So I'm an employee again, which is really wonderful. And it's nice not having to have the entrepreneurial type of mindset right now for a little bit, because it's, you're always worried about, next payroll and that kind of stuff. So it's nice being able to kind of step back into that role. And it's good for my team too. So we're going to go through, and one of the things I want to say, I'd like to have this be interactive if we can. If there's anything that anyone has any questions, if you're comfortable talking about any specifics, please ask a question and we'll go through it. I don't want to I have some slides we can go through, but we can go totally off course if you find something interesting that you'd like to talk about. So I ordered these when we talk about early stage company intangible assets. I tried to order these as kind of like a chronological timeline here. So when you start a company, you've got human capital and know-how, right? That's really maybe the founders, stage one, that's where they're at. That's where the intangible assets are, is in that early stage stuff. And so you're talking about like, maybe there's some domain knowledge, technical skills, really execution ability. And so that's the kind of initial part of it. And then you start progressing as you go down through this to technology. So once technology is developed, you've got like code bases, machine learning models, those types of things. You get data. So data is really important for this, and unique data collected through the product. And then you keep going down, you start developing intellectual property. So patents we're talking about, but it could also be trademarks, copyrights, trade secrets. And so and then you keep going down through to where you get contractual and intellectual and legal rights. And then you get down to strategic positioning. So that's where you're looking at user adoption. And then you get switching costs. So there's integrations, proprietary data. And then you come all the way down to where you're actually in the market selling stuff, and you got brand, market position, those types of things. Then we get down to what investors really underwrite. So I think everyone probably knows this, but it's really the team. Initially, when you get an early stage company, it really comes down to the team. I mean, it's how deeply do you understand the problem that you're trying to address? Can you move quickly, and can you attract strong hires? That's really what it comes down to. Can you recruit? And what does good look like for something like this? It's, you're shipping features every 2 weeks, landing a few high quality early hires, speaking the same language as your customers. That's really important. And you show that with proof to an investor. If you're talking about there's change logs, you've got hiring offer signed, customer referencing, mentioning in your speed and judgment. So that's really the initial part of it. And that's what these investors are underwriting. I had this guy, he was a guy going through a divorce. He had invested probably in over 200 early stage companies, right? And he did that by getting in on some, probably was like 6 years ago, getting in pretty early on some companies, had a huge payoff, made like $60, $70 million in one investment, And then he took all that money and plowed it right back into early stage companies. So, and he was doing small investments, 100,000, 500,000. And so he just, kept plowing it back into that. And he told me, I was talking to him, how do you really assess value for these early stage companies? Which ones you're going to invest in? And he told me, I look at the team and I say, do they look like winners or do they look like losers? That's basically how he does that. And that's like very matter of fact. It's just like a gut feel. And I'll show you some of the statistics as we get on. So he's one of these guys that's really, and that was just his honest answer. Like, it's just a gut feel, really, for a lot of these early stage companies where he's doing seed investments like that. So it's really comes down to the team for a lot of these people. So then you got the early product market fit signals. That's what the PMF stands for. So what are your retention curves that, the daily or weekly active use, all those types of things. Then you got quality attraction. So pilots, master services agreements. That's something that really shows that there's something valuable there. But it's got to be paid pilots. So that's really critical. Are people paying you to work with you or to get your product? Early on, like it used to be, 5 years ago, 10 years ago, is you can run without any revenue for a long period of time. Now it's all about revenue. It's how much, even at seed stage, do you have revenue going on? And, pre-seed, it's fine not to have revenue, but when you get to the seed stage, they really want to see, even if it's service income, like you got a product that you want to ship, there's something there that you can actually sell. So it's that kind of stuff that's really important. And I purposely, some of these things, like these acronyms, I think everyone knows, like in early stage investing, and these early stage companies, there's all these acronyms that people use. And that's kind of like, it's kind of like a hidden language that people use. So I think a lot of people, if you see SOM, it's the serviceable, obtainable market, right? That's different than the TAM, which is total market. Okay. So total addressable market. And so I think it's good. You can probably just ask ChatGPT, what are all the kind of acronyms that you should be looking at for this kind of stuff? And because the investors, they're going to use these, they're going to say, what's your TAM? What's your SOM? That kind of stuff. So it's really critical to know what these kind of silly acronyms are. Does anyone know what CAC stands for?
Customer acquisition cost.
You're right. Yep. Customer acquisition cost. That's really good. So it's that kind of stuff. But we'll go back. I'll go to the market wedge. So that's the market wedge is, and that's what I'm trying to talk about early on. What is your market wedge? What can you actually sell today or in the next 90 days, next year? What's your addressable market that you can actually sell something to? And that's really just to get your foot in the door. So once you do that, you tell the investor, trying to get my foot in the door, we got some revenue. And then we're going to expand and have all these extra features that we get into after that. So I was trying to get into that there. Looking at the unit economics, directionality, the customer acquisition cost, payback trending, what's that look like? Improving your gross margin, net. So benchmarks commonly track the net revenue retention. So net revenue retention is you've got customers and, how do those same customers compare in terms of revenue? So the revenue you did with them last quarter, last month, whatever it was, and if you got 100% or greater net revenue retention, then you're expanding your customer base and expanding that revenue to them. Churn, CLTV, that's customer lifetime total value divided by customer acquisition cost. So that should be like a 3 or more. So you got to kind of look at these types of metrics. And one of the things that I think my really good friend did very well is every month, every couple months, he would send out a really excellent summary to all the investors, saying all the stuff that they're doing, all the people that they're trying to hire. They say, we have these 10 positions open. Let us know if you know of anyone that's really good to fill these positions. So it's doing that kind of stuff is really good. So having the repeatability, so pipeline stages, win-loss, cycle length, defensibility, you want to have switching costs, you want to have data advantage, network effects. I think everyone knows, Facebook has a network effect. Once people are on Facebook, they It's more difficult for other people to switch. So you want to get these types of moats around your company. And runway versus milestones. Your runway is how much cash and what do you have to do to get to the next milestone? And what are your next milestones? And do you have enough, is there enough cash to get there? For the pre-seed, seed, like early stage companies like that, well, I'll show you the stats. The biggest one is gut feel. That's really the bottom line for a lot of these investors. It's just the gut feeling. There's a market. So once they make a decision that they want to invest in a company, they look at how big the market is, you know, your TAM. What do you actually think they can do? And we'll go through some of this. And then they say, okay, well, you know, I think it's like a $5 million valuation, you know, or it's a 10 million based upon the strength of the team. So, and I'll talk about some of the stats there, but if you're a first-time founder, not so great, you know, in terms of it's like 18% success rate of actually continuing on, I think, about that. And if you're a second-time successful founder, it's like a 30% success rate in going on. So that's why the team's so important. You can like by having a second-time successful founder, you know, the valuation goes up a lot. And so, you know, some of these people that I see and you know, the other thing is if they're starting a company, they've already been successful, they had like a $100 million exit, and they're still at it and wanting to do it. There's something pretty special about that person or messed up, honestly. Like, why do they want to keep doing and making more money? So it's maybe something these investors feel like they can put their money down on them. But we'll get in. Yeah, we will get into that. I think. Yep. All right. All right, so as we go down through, I just want to talk a little bit because I think a lot of people hear pre-money, post-money valuations, those types of things. So what I've got here is an example of, you know, pre-money, post-money. I guess how many people have heard pre-money or post-money valuations? Yeah, okay. So it's something to be exposed to. It's actually, you know, just so if people are talking to investors, how do you deal with this stuff? The pre-money valuation is the company value before there's new investment, before the new cash comes in. The post-money is just the pre-money valuation plus the new cash, okay? And so the way it works, we'll just do it with this example. We'll do the first scenario. There's no pool, which means option pool. So as usual, a lot of times these companies will reserve 10% of their cap table for option holders. But we'll do the first one with none. So they say, however they come to it, they say our pre-money valuation is 12 million. We'll talk about how you actually get to a $12 million valuation. The new money is 3 million. So that's the investment coming in. So the post money is 15 million. All you do to come up with the percent ownership of the new investor and the founders on a fully diluted basis is taking that 3 million and dividing it into the $15 million, and you get 20% to the investor, 80% to the founders. Okay, so it's really simple math. Like it sounds a little complicated, but it's actually very simple. And then the second example, we don't have to go through it, but in that example, they're holding back 10% for the employees to give them, you know, options over time. That comes out of the founder's share typically. So that'll be something that the founders have to give up. So that's why the founders end up with 70% in the end there. So any questions about this one? Because this one, it's kind of like, you know, it sounds complicated, but it ends up really not being, it's really not too complicated. More complicated one is when we get to the next one, which is where you've got a safe. So a safe note. So it's something that is usually used for early stage companies. And you have a safe note because it basically you don't want to have to set the valuation of the company. So you say, I'm going to give you $100,000 early stage company, and it's a $100,000 safe note, or in this example, it's $1 million safe note. And we're not going to set a value now, but at your next round, when you actually do get money, we're going to get because I'm giving $1 million now, I get an 80% discount, the lower of an 80% discount, or I give a $10 million valuation cap. Okay, and so the reason you do that is because it's too early stage, you just don't know the value of the company. And so you do the safe note. So now we're saying, okay, you gave the $1 million, you got the safe note. And how do you work out the math for this? And I won't go through it in too much detail, but we'll go down to the fourth bullet there. We'll go down to the second bullet. So a safe note, $1 million with a 20% discount, $10 million valuation cap, converts at the lower of the discount or the cap price. So the discount price is $1. So we're saying this has a $12 million pre-money valuation, and we're saying there's 12 million shares outstanding. So it's $1 per share. Okay. And so it's either $1 per share. The safe note will convert either at the lower of a 20% discount, that'd be 80 cents per share, or a cap price of 10 million divided by 12 million, that converts to 83 cents per share. So the discount wins. So that's basically, so it will convert at a 20% discount. And so the way you work that out is you got the discount wins, that's the safe, in parentheses, discount wins, $1 million investment. That means that they get 1.25 million shares, the safe note does. And if you take the 1.25 million, divide it into 16.25 million shares, they get 7.69% of the company. We won't go through it too much now. I just want to put on the slide so you can kind of noodle through it as if you want in the future. But it's kind of this is actually very simple in terms of how these cap tables typically look. Like when I've had to run through and value these companies, you got series A, B, C, D, and they've got options, warrants, like all these different types of things. And you gotta specifically model each one of those to come up with the value of the company. So this is kind of like the prior one, but with like a little twist. So, but these cap tables can get very complicated. And you want to make sure as your company's growing that you have a clean cap table. There are no disputes. So if you have a dispute between the founders as to who owns what, that can bring the value of the company down a lot if there's a dispute there. So you want to make sure everything's really documented well. I've gone into these companies and they've just been a mess. They have no idea. There's all it's just lawsuits waiting to happen for a lot of these things. So you got to make sure it's really well documented and really clear, who owns what. Any questions about this? I know we're not going to get too much into it, but I just wanted to give a quick example. All right, so this kind of gives a good example as we go through the different stages. So this is the stage progression as you're going through from the different pre-seed, seed, series A, series B. This can go all the way, series D, E, F. I mean, it can keep going on and on. And then once you get to past the series of venture capital investments, then private equity comes in. And then for growth capital, and then you've got bridge financing, like loans. They get like 10, 15% in interest rates to bring the company either to an acquisition or to bring them to an IPO. But when you got pre-seed, typically you got a prototype, you got 5 to 10 discovery calls per week, hopefully those types of things happening. There's design partners, you got pre-product type of, signals, provisional filings, assignments, freedom to operate type of patent searches going on, clean cap table, and simple performance indicators. So it's those types of things, but probably no revenue. Now I'm seeing a lot more of that as you get to the seed stage. They really want to see money. They want to see revenue coming in there. So you got for seed, you got V1 shipped, you got first paid pilots, early retention, you got the moat that your intangibles is a data plan. In finance, you start looking at these customer acquisition costs, those types of things. You get down to Series A, we're still in early stage companies, but you got repeatable sales, you got consistent growth, you got IP data moat, forecast accuracy, you look at how much money you're running through. In Series B, that's when you're really trying to scale it up from there. So that's really when you're trying to get the runway to scale. Any questions? Anyone want to talk about where they're at with their company on this right here? Or how any questions about where their company kind of fits into this? Yeah, it's a good question. I mean, like when I was at Autocline Imaging, this is many years ago now, this is, a couple decades ago. That company got started with SBIR funding. We did phase 1, 2, and 3. And, and so we, SBIR funding, I think, that can continue way past when you got 10, 20, $30 million in revenue. But if you only have SBIR funding, that's probably, that could really be pre-seed, I think, if you're only SBIR funded, because it's not someone outside a customer saying, I'm going to part with my money and take what you're selling, if you're only that. But then Autoquant Imaging successfully used SBIR grants to fund our next product. So we'd say we want to go into, this particular, like we're tracing proteins and stuff like that. And so we wrote that and got a phase 1 and then get a phase 2 and then you get a phase 3 for like, $1 million or something like that. So. It's much harder. Yeah, it's much harder. And so, if you're basically, there's a couple different ways. I think even if you can get some type of consulting revenue, I think is possible. Like, so I'm always about getting revenue in the door somehow, but not distracting too much from your core focus of your product. So if there's any way to get any kind of consulting revenue, gathering, data that could possibly monetize, but yeah, it's basically, it's an issue with something that needs to go through an FDA approval process. You're not, but that's where you can, you're working with kind of a different, it doesn't fit as neatly into this, but you're working with a different funding source. Those venture capitalists are maybe paying for, you got to find partners, what I found, pharmaceutical companies that'll partner with you. And it's a little bit of different than your milestone based where you hit your first milestone, we're going to give you another, 10, 15, $20 million. And so, and they're writing big checks for that kind of stuff, but it's tough. Yeah, it's much tougher to get the revenue if you're, trying to do pharmaceutical or medical device, something like that. Like angel investors could help out for a little bit, but that'll just kind of keep the lights on, do some initial research. It's really, and that's why, who the founders are really important with something like that, because if you have a successful founder or people on your board that are, and they've got some, hopefully have some equity, that'll help make introductions. But I think it's partnerships. It's finding the right, pharmaceutical company or someone to partner with. And they may pay some money for some optionality on whatever product you're trying to, get out the door. I've seen a lot of medical device companies, pharmaceuticals, they don't start the human trials in the US. They have to go to other countries to start them. There's incentives to that. So, but yeah, no, it is hard doing that. Yeah. A lot of them are gut feel, but what they like to see is like a discounted cash flow method, typically is something like that, where you show your whole revenue model. Like even if you have zero revenue now, it's like, how many customers you're going to get, what products you got to get out the door. And they want to see your thinking about how much money you're spending. So I'm writing you a check for $1 million. What are you going to do with that money? And how's it going to get you to your next milestone? How much more money do you have to raise to then get to the next milestone? And so even if it's totally made up, they want to see a well thought out type of plan as to what that growth curve is. And then ultimately they, in the end, in 5, 10 years, when you sell the company or go public, they want to see, what's that value then? And a lot of times they do like what you call the venture capital method that I'll talk about. And they just say, we're going to sell for 100 million. We're going to discount it by 30-35% per year. 5 years out, we're discounted by 30-35% per year. It goes back to, $5 million, $10 million today. So it's not so much what the math is, because that's going to be wrong. It's going to be wrong, whatever you come up with. It's more about your thinking and showing that you actually have a plan. Yes. All right, so we'll get to that. Okay, so this is where I just wanted to show quick the usage of the valuation methods. So this is from the Pepperdine survey. I use this a lot from 24. Usage of valuation methods for angel investors. The first one, the 28% there is gut feel. That's how they come up with valuation, for companies, 28%. The red there is 16%, that's discounted future earnings. That's a mathematical model. You're saying I'm projecting this amount of revenue and profit in the future, and I'm discounting it back to present value. Then they go into capitalization of earnings method, which is not, it's kind of silly for an early stage company. They're kind of silly for doing that. Guideline public company method, again, kind of silly. Transaction method, these things are like so early stage. Net asset value is the 3% there. That's just tangible, that's one thing. The title of this whole presentation is Beyond the Balance Sheet. That's the balance sheet, the adjusted net asset method, right? And so they're not just doing that. All these things are about the intangibles there. This is the valuation multiples method. This is, and I put it in here just so everyone has the data. So if in the future, when you're looking at it, but this is angel investors. The top is pre-seed, seed, early stage, growth, expansion, and later stage. And this is a survey sent out to angel investors. So just so everyone knows, when you're asked, depending upon who you're asking for, it's an angel investor, venture capitalist. They're looking, there's a market. If you're a successful, early stage company going to look for money, their time to, let's see, the revenue multiple, okay, the very bottom, average company value at time of investment. Pre-seed, the first quartile, the 25th percentile is $1 million for the whole company. Third quartile is $4 million. So just so you know, when you're talking to venture, say angel investors, they're looking, don't go in there and say our company's worth 500,000. Don't go in there and say our company's worth $20 million. If you're pre-seed, you're probably going to fall within that range. Maybe you can get 8 million, or 10 million if you're an early stage and you got a really great founding team. If you're a first-time founder, maybe you're closer to $1 million valuation. So just so you kind of know where you're fitting in there. And then you go into, let's just say startup early stage, the valuation of the whole company is between $4 and $15 million. So just so you kind of get a sense as to where you should be. But this has really excellent data, time to exit at the time of the investment, the discount rates, plus, And then we go to venture capital funds, a little less data because they're not really investing in pre-seed so much. So there's not much data there. And when you get to the seed and early stage, venture capital funds, they're writing checks, but they need much bigger returns. So they need to invest in something that's got a much, they have investors to, that they have to give updates to and have audited financial statements. So their company values between 4 and 15 million for the seed stage and 11 to 35 million for the startup early stage. So just so when you're talking to these people, and then you got to look at when are they going to get their money out? They're looking to get their money out anywhere from 4 to 7 years. They got to turn it over. A lot of these venture capital funds have a life of 10 years, and then they have options to extend it 2 additional years. And if the LPs agree to do that, so it's kind of a thing to really keep in mind when you're asking for money. And then VCs, they're more sophisticated than the angel investors. They're only 7% for gut feel. Most of it, when they're coming up with valuation methods, 36% last round of post-money or most recent financing. So they look at that for that. VC method, which I'll talk about. Guideline public company method, you look at a comparable public company and derive valuation multiples. So you can kind of see their later stage. I think we already kind of talked about that. Really this, I think everyone knows this, but you got your IP and data. Patents are very, very important for a lot of early stage companies that are in this. They're looking for, your claim breadth. Are they enforceable? Your patent count doesn't really matter so much. It's kind of what does your portfolio of patents look like? Clean ownership, freedom to operate, all those types of things are important. And so these are the kind of indicators as to that your intangible value is actually, that you have intangible value. What counts? Paid pilots are really important. Purchase orders, renewals, cohort retention, reference customers. What counts? Letters of intent with dates, pricing, penalties, those types of things. what's noise, what doesn't really matter, NDAs don't matter. I wouldn't go telling venture capitalists that we have, 10 NDAs or something like that. That doesn't really matter so much. But paying customers matter. Your patent count doesn't matter. Logo doesn't really matter so much. But you got to show a short cycle of like, you got a problem, you test, and then you move your metrics to the next stage. And then these, I think the deal terms, like I said, do affect the value. So I won't get into it too much. There's a whole list of things that are deal terms. So there's the valuation of the company, but I always say just as important are the terms of the investment. That's actually maybe even more important. The liquidation preferences as an example. You could have participating preferred stock investment or non-participating preferred investment. Participating preferred investment means that if venture capital invests $10 million into a company, they sell the company for $100 million, they get their $10 million back off the top, and then they also get their percent ownership of whatever's remaining. Non-participating means they got to choose. They either get their $10 million back or they got to convert the common and get their pro rata share. So it's those types of things like that. That's a huge thing. And that's why it's not always good. Like when they're saying, we used our reference point of the most recent valuation is for the valuation method, is because these venture capitalists, angel investors, get all these preferences that really affect value. So you can't really say, what someone invested in is preferred stock, and I've got a post-money valuation of $15 million. It's not really worth $15 million. If you go to try to sell a company and you say my post-money valuation is $15 million, no one's going to buy it for $15 million because they're investing in preferred stock. They get all these preferences. They get maybe board seats. So they're buying control and a hope and a prayer, really, that the company's going to pay off in the future. So typically common shares, which is usually what founders have, they could be worth anywhere from a 20% discount to what the preferred invested in to they could be worth 4 times less. I've heard people say it used to be 10 times less, but I think it's come up since then. So it's really worth, your common stock's worth a lot less than what the venture capital is investing in. So here we'll go through some of the valuation methods. So the VC method, all they do is, and again, this is just quick deal math. Like they don't, this is how they do it. It's more of a gut feel kind of sanity checks that they do at the early stage companies. But they say, we're going to do, $20 million in revenue in 5 years, or probably that's too low, really. They say we're going to do $100 million in revenue in 5 years. And it's a 2-time revenue multiple at the time of exit. So it's worth $200 million is what we think our company is going to be worth in 5 years. And then all they do is they say the investor needs like a 35% annual rate of return. And so with that final exit of $200 million, they discount it by 35% each year to get back down to the present value. So it's like the quick concept is there's some value at the exit. Yeah, however they come up with it, usually it's a revenue multiple. And then they discount it back to present value. So you could have something that says like, we're going to exit at $200 million in 5 years. That can mean it's only worth $10 million, today, based upon the math of it. And so that's when people, if they say VC method, that's what they're talking about. It's pretty simple and straightforward. Market multiples. So market multiples, again, they're really using probably revenue multiples for a lot of these things. So they're saying, again, it's like, Facebook, for example, initially, or Amazon, they didn't have any profit to really come up with a valuation of cash flow. So they were looking at revenue multiples. And that's what a lot of early stage companies are still doing, is you either look at like guideline public company method, where they've got publicly traded comps, derived valuation multiples, maybe they're selling it 2 or 10 times, revenue. And that's because they're expecting a lot of future growth. So that's why they're using revenue, because they actually don't have profit yet. And then you say, well, our company is, much smaller. And so then they reduce the valuation multiples down, for those things, and then apply it to your own company. And you can do a multiple to trailing 12 months revenue. You can do a multiple to forward revenue. So you think, we're projecting, we did $1 million in revenue this past year. We're expected to do $10 million in revenue the next year. How realistic is that? And then they apply a multiple to that forward revenue is what it would be called too. The scorecard in Berkus. So again, This is a very subjective type of method that they do, but the scorecard or BERC is typically what they say is, there's all these milestones, like you got the idea, when we get to the prototype, it'll be worth $200,000, that'll be another $200,000. The team is probably worth $500,000. And then they weight those. So it's got to add up to 100% weight. But they come up with values for each one of those stages, and you see kind of where you're at. You multiply it by the weight, add them all up, and you come up with a value. And so you may hear scorecard or Berkus method, very subjective again. And what I prefer and what I usually use is a DCF. So DCF and scenario analysis is really what I prefer and what I do. DCFs, discounted cash flow methods, what you're doing is again, like I mentioned early on, you're coming up with like, this is our metric. This is how we're going to get revenue. So when you're forecasting revenue in the future, there's a whole lot of assumptions that come into that. So you got to look at, what's it going to cost to get your customers? And, when you actually get your customers, this is what our pricing model is going to look like. Or if it's, pharmaceuticals, you got to look at like, this is the $150 million we got to spend, just to develop whatever we're developing. And then when are you going to actually become profitable? And so that's basically coming up with that revenue model, coming up with your expenses, what's your gross profit margin, what are your overhead expenses, and then coming down to the bottom line cash flow. This is how much cash flow we think we're going to get. And then you discount that cash flow back to present value and come up with a value. And you got a terminal value in there too. And so that's what I would prefer, because it shows so much more thought. Now, it's totally made up. It's very assumptive. There's a lot of things that go into it, but it shows your thinking. And so when you're talking to an investor, you can actually give them the model. And they're not going to believe you, but they will take whatever you did and they'll do their own valuation model. But it's really good. Instead of just saying, well, I think it's $5 million, it's a gut feel, it's kind of coming up with a systematic type of model that shows your thinking. So idea, prototype, team, relationships, and then actual sales. Yeah. So team would be the highest. For an early stage company, you're looking like probably 25% of the weighting would go to the team, probably. So how to present your case to investors? The question is, why now and why you? That's really what it comes down to. That's the biggest thing. Why are you uniquely qualified to capitalize on the opportunity? That's really what drives the value of the company. What is the problem? Why are you a good fit for addressing the problem? You're uniquely qualified. There's no one else in the world like you that can address this particular problem. That's the ideal. You got a moat map, so you got IP, you got your data, switching costs, partnerships, you got your evidence, paid signals, retention, reference customers, you got your plan for the milestones, and then typically triangulate value. Maybe you do these things and you come up with a discounted cash flow method, you do your scorecard, you do market multiples, and you say, come up with the different types of methods. And then you got to reconcile them somehow. And so maybe the discounted cash flow comes up, which I would put the most weight on, comes up with a value of $10 million. And then, your other methods come up with a range of 6 to 15 million. And so maybe you say, well, the 10 million makes sense, and then the venture capitalist is going to come in and say, you're an idiot. You don't know what you're talking about. It's only worth 5 million. Exactly. So hopefully with focusing on these things, what they're most concerned about. And that's how you say our value should be 6 million or whatever you come up with. And the good news is right now, there's so much money chasing too few deals out there right now. So there's a lot of money out there. A lot of these venture capital firms, they have a lot of money, a lot of dry powder. They're looking to make investments. So you got to find venture capitalists probably outside your geographic region that are experts in your particular area. Yeah. So I think there's demand for, from investors, like they're looking to make investments. They have to make investments. They have capital commitments that they have to invest. But you're right. I think it's, so then you just got to stand up there and show why you're particularly qualified to capitalize on that particular opportunity. But then we use these valuations, these are just
Sure.
models that we do.
Yeah.
Like when I'm valuing a later stage company, like it's got $100 million in revenue already. It's got stable 5% growth every year. That's much easier to value than an early stage company with no revenue, you know? So that's where we are using market multiples, guideline public company methods, those types of things.
With that, I think we're at time. Wanted to say thanks, Scott,
Yeah, no pleasure.
for his time, and thank you all for coming.